Predictions for the Connecticut real estate market in 2023. Hi, I'm Dave with the Bold Realty Group. Welcome to my weekly real estate market update. It's December 30th. It's the last update of the year. Happy New Year, everyone. Please like, subscribe, ring the notification bell to get the word out to others who might be interested in the information I'm putting out. And certainly with these predictions, I'm sure I'm going to get some people that disagree. I look forward to hearing your thoughts. Throw some comments down below. I answer all of them. Before we jump into that, just want to touch on the Connecticut market as it stands right now. 4,253 active homes on the market. That's down over 150 from last week and over 2,000 over the last couple months, which is about a third. So it's down quite a bit. We have about 3,039 closings in December so far. Today's the last day for closings. We'll probably get to 3,100 or so, which is very close to the November number of 3,160. So demand's kind of flattened out, it looks like, and it is down dramatically. That's about 1.35 months of inventory, so very low inventory. So get into the predictions. The first prediction is about foreclosures. Foreclosures will approach 2019 levels, but I don't think they're going to get there. The reason I say 2019, 2020 and 2021, they're more moratoriums, so it's kind of odd years. 2019 is the last normal year. Delinquencies for mortgages right now are very low, 2 to 3%, versus 10 to 12% in the 2010 to 2012 range. And also, high equity and very low inventory gives homeowners the opportunity to sell their house rather than go to the foreclosure, which is something they didn't have in the 2010-2011 range. That they can give up a little bit of equity in order to price aggressively and still be able to walk away with some money in their pocket to be able to go to the next thing. So I think foreclosures will approach 2019, but they're not going to get there. Inventory of homes in Connecticut will continue to be very low through 2023. Why is that? Well, let's look at the sources of inventory, sources of supply. Construction, it's flat in Connecticut. Other parts of the country, they're pulling back. I don't expect to see a massive explosion of construction. Hopefully I'm wrong on that one, but that's where we are right now. Foreclosures, as I just talked about, they're not going to be a major source of inventory on the market because there's just so few of them that are even at risk. And then high prices and interest rates are leading some sellers to delay selling. People are staying in their houses longer because they're looking at the market and saying, yeah, I could get a great price right now, but then I have to go buy at that same high rate. And not only that, but I have to give up this low interest rate loan that I have and pay a much higher one. So there's a lot of play going on there as well. So I think inventory is going to be flat. Next one, the third one, mortgage interest rates will end the year around 5.5%. So inflation seems to be cooling off. The other thing that I've noticed, and a lot of others have noticed, is mortgage interest rates typically track the 10-year Treasury about 1.7% or 170 basis points higher than the 10-year Treasury yield. Right now, they're 2.9% or 290 basis points higher. So that extra 1.2% or 120 basis points is something that is in place, I think, because people are unsure what's going to happen. So they're pricing in additional increases from the Fed, and they're also pricing in the fact that at these higher interest rates, if the interest rates go down, these mortgages will be refinanced. So they're trying to capture as much money as they can as quickly as they can. And so I think as the interest rate picture clears up across the board, I think we'll go back toward that mean of 1.7% higher, and interest rates will come down. The fourth one is U.S. home sales. I think they're going to be lower in 2023 than they were in 2022. 2022, it looks like it's going to be about 5.8 million homes sold. The forecast right now that I'm seeing is on average 5.1 million. I think it'll be closer to about 5.5. Low inventory and reduced demand means fewer sales. That makes sense to me, and that's the situation we're in. Inventory is very low. And because of the high interest rates and high prices, demand is very low as well. So you're not seeing massive numbers of sales. As interest rates go down, which I just talked about, I think more buyers are going to come into the market, and so sales will start to increase. And what we'll see there is those numbers will go up, but also the prices will start to climb a little bit. I think that's going to be in the second half of the year. So that's why I think even though the forecast is 5.1, we'll get to closer to 5.5. The final prediction, prices will remain flat in the first half of the year, and that's year-over-year prices, will remain flat in the first half of the year and climb in the second half of the year by 2 to 3%. So the year over year November median sale price in Connecticut, as an example, in 2021 it was $310,000. In 2022, $330,000. So we have seen prices go up from 2021 to 2022. 2021 was a great year in the real estate market. 2022 started out pretty good and it's gone down a little bit, but we're still above the 2021 numbers. I think we're going to start flattening out, and then in the second half of 2023 we'll start to see a little climb start happening again. The reason I think that is supply and demand are kind of balanced right now. Even though inventory is very, very low, demand is low as well. So prices are stabilizing. If interest rates start to come down more, closer to that 5.5, like I said, and demand picks up as a result of that, we will see more sales happen and we will see prices start to climb, because I don't really see where the inventory is going to come from. So demand will go up, supply will stay relatively even, and that causes prices up. So those are my predictions for 2023. Love to get your thoughts and your input as to why you agree, disagree, what you see differently. Talking about the primary mortgage market survey, we're at 6.42%. So we're kind of flat, up a little bit from last week, but kind of flat. It'll be interesting to see how this plays out as time goes on. There's where we are now. Be safe this weekend celebrating, the standard stuff, no drinking, driving. Please take care of yourself, take care of your friends. I look forward to talking to you all in 2023. Happy New Year.